Good morning, welcome to the Market View for Friday the 20th of June 2014. And starting off with yesterday's activity within the 30-minute British pound, we can see that we had a buy signal, but unfortunately it didn't fill within the 3 bars. And this is the market breaking through the 170 resistance, which I spoke about yesterday, and the market continuing up to 170.50 before finding resistance and then pulling back during the evening, and in the early hours of this morning we can see the market moving back towards the 170.50 there at the moment. So the market has broken through the 170. So what is the next upside target? To do that, I am going to go to another piece of software that I created many years ago for end of day trading, and I'm just going to have a look at the pound, and I'm using the CRB data, which I can go back to the beginning of this contract. You can see I can just keep going back. This is a monthly chart, by the way, and go back all the way to 1972. So if I want to see where the pound is trading in the longer term, this is the data that I actually use, and it's great because, as you will see in a moment, it's gives a great picture of where the market is trading, or where it's trading to as well. So you can see the market's broken out of the 2011 high, if I can just click in the right place there, at 167.38, and now we're at the 170.44. Yesterday's high was 170.52. The market closed on the IMM session at 170.32 there. So a break above this 170.44, which I think it may be trading above that at the moment. Let's just have a quick look. Yeah, 170, believe it or not, 170.48 at the moment there. So a break above this will take us to this next upside target of 179.20, 186.24, and then back again, still in 2008, 197.80, and we've got this spike here at $2.39, $2.67, and then finally the high of 2007 before the credit crunch hit at 2.11. So there you can now see all of the upside targets that are available for the pound should it break out of this sort of ascending triangle pattern. This is the top of the pattern, and this is what it would what it looks like. You've got this sort of squeezing effect of prices there. So a break above the 170.44, which we're at the moment, again convincingly, we'll see the market possibly trade up to 179.20 there. So let me just save that for future reference. But like I say, the great thing is we can go back and we can see, and you look at it and you think that that's the actual high, when really it isn't. You know, there's a lot more highs in the background there, back to the 1970s. So far as this market is concerned, we've got this is the picture in the near term, back to 2008 now, and a break above 170.44, which we've got at the moment, but of course it's got to close above that convincingly with an increase in volume. So let's just have a look at the daily chart of yesterday. You can see there the market coming off the highs, took a moment or two to get going, but traded through. So we can remove these because the market won't be coming back to these lines anytime soon, unless there's some sort of geopolitical event that sends the pound into freefall, and we'll remove this as well. So anything on the downside at the moment would be based upon, problem there, start again, would be based upon coming back to these levels, which is going to be from, I can get in there, It's the other way around. It's going to be off the bottom. I've just clicked twice off this on the low of this bar to give me the potential downside target should the market come back, which again is at the 170. So the 170 is a crucial area for this market if prices do move lower today. So moving on to today's news, let's have a look, see what we've got. No high impact news items whatsoever today, so it'll be an interesting day to see how it unfolds with regards to moving prices around. So nothing on the economic news front there. As far as the Dow is concerned, let me just bring this up for you as well so we can have a look at the longer term chart for the Dow. This is the daily chart for yesterday. You can see we've closed above the 76% retracement. The market opening, trading lower, finding support, and then coming back up. The same picture that we've seen all the way up in this run here until we had a couple of days where the market pulled back. And ever since then, we've had that same picture. Opens, moves lower, comes back. Opens, moves lower, come back. Opens, lower, trades lower, comes back. So very easy to trade at the moment on the intraday because of that. You just wait for the market to find support, and then you can trade it back to the upside. And I'll be showing you more of this next week. We had a few issues with the Dow data and certain time frames in the software, which we've hopefully corrected now. So that's why I've not shown any Dow charts on an intraday basis as yet, but hopefully that is sorted now. So the next upside target is 16,946, and then the all-time high of 16,970. So what is the rising prices, or the impact of rising prices having on the implied volatility? Well, yesterday we moved lower once again. You can see there the 19th of June, 842. It's becoming a bit of a cliche from me, but it is unprecedented. I have never seen this before. There is a total disconnect from the fundamentals, and even Zero Hedge, there's an article on here about it, what could possibly go wrong, and I have to agree with this, that it says here, while Janet Yellen yesterday explained that low levels of realized and expected volatility in the financials were not a signal of complacency, we suspect, like the Fed's Bill Dudley, some are concerned she is talking out of her academic rear end. And as JP Morgan warned, volatility is currently dislocated from fundamentals, and the day of realization is approaching, and it has to be. You can't have this. It may be disconnected from reality, but eventually, in historic lows and implied volatility, and we are at historic lows, there is going to be a major, major correction in this market, because that's how it's always been. The only difference, and I mentioned this in the implied volatility video that I created, is that we do have several trillion sloshing around in the markets from or with taxpayers' money from the Federal Reserve, and that's obviously what's keeping it aloft at the moment. But it only takes one geopolitical event, another banking crisis, which the banks are still not out of the woods from 2008. So it's just a matter of time before this actually comes back into alignment, and it will. It always does. The market always finds its balance, but it's going to take something significant to do that, to start with, some sort of catalyst to trigger and correct it. But again, when you get the rhetoric of there's no risk anymore, this is fine. We had this in 2007, and I kept saying to people, beware, be aware, be warned, this is not normal. And then eventually the cracks appeared, and then the banking crisis came to the fore. And we saw, as you can see from this volatility here, this massive spike as the market's corrected by 50%. So when everybody tells you all is swimmingly well, all is fine, don't believe a single word, because that's not how the markets have worked in the past. As for a date when it's going to happen, well, that I can't tell you, not even with a crystal ball, because we have no idea. But one thing is for certain, the lows in volatility like this are extreme, and extreme lows produce extreme moves. So this is currency and equity implied volatility, as you can see both, which is why we've had little or no movement in the currency markets during the last few weeks, because there is the volatilities are so low. But when they go, then expect some really good moves in these markets. Well, that's it for this morning and also for this week. All things being equal, I will see you in Monday's market view. Have a great weekend. As ever, thank you for your support. Very much appreciated, also for the feedback, and also for watching.